Today I'm going to talk about introduction to technical analysis and some of the features that we have at Tradespoon to kind of automate technical analysis that can give you specific entry and exit points for your trades. Thank you again for the introduction. Again, I was the Chief Technology Officer at Options Express, and my passion is working at different startups. I work at different hedge funds here in Chicago. For the past 15 years, I've been trading, building algorithms to do quantitative trading so we can find perfect trade setups based on the quant models that automatically does technical analysis, backtests, and tells you what are the probability of stock being higher or lower at a certain time frame, which we'll cover shortly. And for the past 2 years, I've been teaching how to trade to Tradespoon subscribers. I'll just take a moment to look at some of the disclosures. Options do involve risk. They're not suitable for all investors. Please consult your advisor before making any trade recommendation. We are not registered independent advisors. We're not registered individuals, so all of the recommendations here are designed for educational purposes only and should not be considered as a recommendation. Presenter Vlad Karpel and the team at Tradespoon may have financial interest in some of the recommendations or some of the examples that you will see on the screen. So before we jump into technical analysis, I want to make sure we do talk about common obstacles that previous presenters already covered. One is leveraging capital in order to day trade. Some of the accounts require at least $25,000 to day trade, especially when it comes to equity or option equity. When I started at Options Express, we were encouraged to trade, so we understand how to design the system. And when I started trading, I quickly understand that in order to leverage your capital and in order to minimize your risk, you have to invest in several names. And if you trade Google or you trade Apple, you might not have enough capital to diversify the risk, and you invest in only in 1 and 2 names. And ultimately, when you do have a geopolitical events, you might lose money even though you are right on the direction and timing. Now, that's kind of the most frustrating issue for traders, is that you can be correct on the timing of the trade and you can be correct on the direction of the trade, but certain events, binary events such as an ECB news that we might have this week or the restructuring of Greek debt, when that event happened, whether you're a day trader or whether you're a swing trader, whether your time frame is hours and minutes or it's longer, weeks or months, you can get stopped out of the position, and the next day or next 10 minutes you see that the trade actually goes in your direction. So in order to avoid that, you got to have a trading plan. If you don't have a trading plan, that's kind of what gets you in trouble. You got to make sure you understand what your risk parameters are in terms of risk and reward. Up front, you need to know what is the return on capital, how much money you're willing to lose and willing to make, and try to avoid the psychology from trading, because if you don't have a written trading plan where you know what your specific entry and exit points are, what is your perfect setup that you're using to get into a trade or get out of the trade, you tend to chase the market and you work on your emotions as opposed to technical setups. So at Tradespoon, our technical system, we have quantitative models that finds the probability of stock being higher or lower in the next 50 days. So day by day or week by week, we predict where Apple is going to be tomorrow, where Apple is going to be in 10 days or 50 days using quant models. So we believe that technology and modeling can predict the stock movement a lot better than the human eye just by looking at the chart or past performance. So we are having technology to kind of help us finding this perfect setup for entry and exit points when you day trade or when you have a longer trading horizon. So whether you trade in minutes or hours or you trade in days, we are finding opportunities in the market. We're predicting, we're actually telling you where the stock is going to be, in the next day or next 50 days based on your time horizon. So I want to kind of show that, because first, before you trade, whether you're a day trader or you have a longer time horizon, you are combining technical and fundamental analysis. If you're a day trader, fundamental analysis might not be important, but you still need to know what are the events that occur during the day, and you want to avoid trading during major binary events, because if you're just looking at the technical setup, your support and resistance, whether it's ATR or whether it's moving averages, you want to avoid trading during certain binary events because they will skew your results and you'll be wrong on the timing and results in unnecessary loss. If you're holding your positions overnight, then you do have to combine kind of technical and fundamental analysis, and that's what we do at TradeSpoon. So if you're a TradeSpoon subscriber, I'm going to show you, here's the TradeSpoon. I know some of you are TradeSpoon subscribers, some of you are completely new. So if you go to under My Tools, you can actually run TradeSpoon Bulls and TradeSpoon Bears. And when you do that, and I selected 9s and 10s, you can select 8 and 9s and click on Go. But what that does is basically it looks at two numbers, rating and trend. We try to make it very simple and removing, as we said, emotions out of the trading. First, rating is kind of your fundamental and technical model. This is the first model that runs and based on discounted cash flow analysis, earnings, dividends, and price action. It assigns score 1 through 10 for your stocks. So, or an ETF. So 10 means we're very bullish on the stock, and our time horizon is 6 to 18 months. Then the trend model is price forecast, just like I said, for the next 10 days, 20 days, 30 days, or 50 days. We have different independent models. We have two separate models that look into, that basically for the past 25 years, it's learning how did the stock behave during specific trade setups in terms of the support and resistance, and it backtests, and once it finds that the setup for the stock is very high in probability and based on the backtest, it sees there is a high probability of stock being higher in the next 20 days. It assigns, you can see the probability and accuracy on your screen. So you can see CSX, it made earnings announcement last week. So we think that in the next 20 days, 30 days and 40 days, CSX, the railroad company, is actually going to move higher, and we see probability of that event and actually the accuracy of that event. Accuracy being said, we're taking into consideration our back test, and we're seeing how many times we were correct versus how many times we were wrong during that setup. If you want to look at the KR, same thing. We're showing you high probability, low, high, that in a 20-day forecast, 30-day forecast, the stock is going to be higher than it is now, and what is the accuracy probability? If you look at the micron, you see that 20-day and 30-day, the probability the stock is under the pressure, and micron has been selling off, but 40 days and 50 days now, the stock is going to move higher. So it's a perfect information for someone who's a stock trader or an option trader to have that visibility, what's going to happen in 20, 30, and 40 days, whether you trade in weekly options or monthly options. You can also go KR and say Analyze and click on Seasonal Charts. That gives you additional information where we actually show you the predicted price for KR for January 20th, 21st, and 22nd, but we also show you a seasonality of the chart. We're showing you that KR, from the seasonal perspective, going February, March, and April, goes higher. So based on that information, you can take a long position on KR, whether you're using options or stock. So seasonality chart is, we're basically finding for every day, let's say on May 28th, for the past 25 years, we're saying how did KR behaved on May 28th, and we take an average between the low of that year and high for that year. We do it for every year, and once we find that index, we average it out, and we can find the trend, whether the stock is going to go higher or low. We actually did this for Micron. That was the other stock, and you can see that Micron, for the there's 70% correlation since 1991, and we see that Micron traditionally going into February sells off, but then going to March and April it rallies up, and then going to the May. So so you know this information, and looking at the prediction, we know that 20 days our forecast, there is a high chance that the Micron is going to go lower, and that's where we see the Micron has been selling off this year. You can see at the candlestick chart, but then going into March and April, there is a high likelihood that the Micron is going to be higher than it is now. So prices forecast using seasonalities and using the neural networks that can train the model and predict where the price is going to be is just an easier way to look at the chart. You can have short-time price prediction for going into January 20th, 21st, and for the next 10 days. And the fact that we run an independent model and we're only showing you results in our TradeSpoon pools only if all the models actually coincide and show you the same prediction. So annual season charts is also very easier opportunity to spot the trends. You can charts, as we're going to cover shortly, shows you the past performance of the stock, but going into the future, it can also show you what the prices of the stock will be in the future. So the green line that you see here, this is your seasonal chart. This is basically showing how the stock behaves during any given day of the month. And the candlestick chart shows you how the stock behaved in the past year. So let's now do a deep dive into technical analysis. I know a lot of you have been doing technical analysis before and use that solely to make trading decisions. Some of you are new to technical analysis. So technical analysis is a method for evaluating securities which analyze previous tendency in supply and demand in order to forecast future price movements. The main idea of human behavior is repeatable and passes per law. So technical analysis do not attempt to measure security intrinsic value, but instead use charts and other tools to identify patterns that indicate where the price might head into the future. So core elements, while there are many exotic tools that are used by more advanced technicians, that core technical analysis is really just study of supply and demand in the market. This information helps traders determine the general direction or trend from a broader perspective. So at this webinar, we're going to look at the trend, support and resistance, and Fibonacci retracement that you can do on your own when you make a decision if you use a technical analysis, or some of the factors that go into tradesman technology when they're making price predictions. So here's the chart. The most important, if you look at the chart, is to identify the time frame. As you can see, some of the traders we have are day traders, and then you might look at 5-minute chart, you might look at 12-minute bar chart. So every bar on your screen will represent 5 or 15 minutes. So you're a short-term trader, your trades usually averages 60 minutes to 90 minutes, and by the end of the day you're flat at your position. So when that's the case, then you want to look at the chart and you want to look at 5-day chart and 15-day chart. That should be your time horizon. You kind of first have to ask yourself, how long does my trade last on average? And then you have to say, based on that information, what are the different time frames on the chart I'm going to look at. We're usually at tradesmen, we carry our positions overnight, so our trades usually last anywhere from 5 to 30 days. So that means we have to look at the daily chart. We have to look at the weekly chart, and we have to look at the daily chart. And each bar on the chart, as you can see on your screen, will either, if it's a weekly chart, will represent a week, and if it's a daily chart, it represents a day. And if it's a 60-day chart, it might represent 3 to 4 hours of trading activity. So if you're new to trading using technical analysis, or if you use the technical analysis but never looked at different time frames, I encourage you to always look at different time frames when you're making trading a decision, so you can see if there is a confirmed trend on a longer period of time. And usually, as you know, as you will learn during this presentation, you do not want to trade based on against the trend. You hear this a lot. You don't trade against the trend. So if you see the chart of Micron and you know that Micron is going February, March, heading higher, you probably do not want to take a short position on KR. Same thing goes to this tradesman bulls. All of our models, based on 8 and 10 ranking, specify that the stocks are going to be higher for the next 20, 30, 40 days. So if you're a day trader, I guess you can go against the trend. I would still not recommend it, but definitely if you carry your positions overnight, you don't want to short these names: Nike, Kroger, Foot Locker, BlackRock Group. These names, we don't list a lot of names. There's only 9 names, 10 names that made our list. So there's only 10 stocks that we think will outperform the market in the next 50 days. So you definitely don't want to trade against the trend. You want to long these names when the setup is proper, when the setup of the entry into the trade is proper. So here's again different pictures to reiterate. Here I'm looking at the SPX index. You look at the daily chart and you look at the 30-day chart. So on the left you see that each of the bar represents a day, so it's a day worth of activity, and you see that SPX shows that we're in uptrend. But on the chart on the right-hand side, we're only looking at the 30-day chart, and each bar represents only hours. So we see a lot less data, but the trend shows that we're in downtrend. So on the SPX, we know that for the past year and the past 3 years, we've been trading in confirmed uptrend. But if you look in the past 30 days, you see that we're in a downtrend. So you got to make sure when you make that trading decision that both the short-term and the long-term trend confirm the trend. So our favorite representation is the candlestick chart. So if you see what a candlestick chart and why it's important to use the candlestick chart, it gives you a lot of more information than just to look at the line chart. You see a close and an open, and if the close price is higher than the open price, then you see this white bar or green bar sometimes. If the open is higher than the close, then you see it was a down day. So just by looking at the candlestick chart, you can know right away if there is an earnings or if there is a binary event occurred, then you see a big gap between open and close. And you can also see, as a result of these binary events, let's say on the earnings, you want close to be higher if there's a bullish activity. But if the close is lower than the open after the earnings, that it might be an indication of the continuing downtrend for the stock. Same thing is very important, these shadows that you can see on your screen, upper shadow and a lower shadow. It shows you intraday high and intraday low, which also can show and give you an indication of how much volatility for that day or for that time frame we had in the market. So doesn't matter if you're a technical trader, you want to look at the support and resistance. That's very important to see support and resistance line. Here you see, and that takes time. It doesn't matter what your setup for the trade is, whether you use Ichimoku clouds or you use the Bollinger Bands or you use RSI index or you just look at the support and resistance lines, but you got to learn how to identify them. That's kind of art. It takes years of experience to learn them, but you got to be patient and find out how to do that. And the idea of support and resistance, as you see it on the line, is kind of where the buyers and sellers influence price decision, where they meet. So you can see in green line that's support, those are the valleys of the mountain, and the resistance are your picks. So support is where demand and supply meets, and usually like before the earnings or before the binary event, you see the bulls and bears kind of, you draw a line in the sand. When I visualize support and resistance, kind of line in the sand, there is about a binary event that's going to occur, and then it's a tag war between bulls and bears. And if there's an earnings announcement and the stock goes up, like let's say for BlackRock Group, they announced earnings last week, the price went higher, then you see that there's a spike in the price action between the support and resistance. It bounces off of support, bulls win, earnings exceed the expectation, and the stock is going to the upside. If you look at the financials, banks, big banks, JP Morgan, Citigroup, they made earnings announcement and the stock actually sold off because they didn't meet the earnings expectation. Then you see there is a kind of a sell action off of the resistance. And it takes time, again, to kind of spot these support and resistance line, and it takes time. So let's look at the charts. At Tradesman, we do provide you charts for any of the trades. So if CSX, we provide you with stock recommendation, stock option, and option spread recommendation with specific entry and exit price points for each of the trade recommendation. We do it once a day, I'm sorry. And then we also accommodate with the stock chart. Since we are holding positions anywhere from 5 to 30 days, we are doing a 60-day chart. So we're showing you 60 days worth of activity, and you can see this is the CSX chart, and we see that after the earnings announcement, stock is heading to the upside. So you can kind of visualize that this line, 33.5, was kind of your support, and now we're heading to the upside. And as long as we break this 50% retracement on Fibonacci retracement, we most likely going to reach in the next 30 to 45 days 36.5 price level. So here's an example of Apple earnings. What is the price support? The price support is this line. You can use Fibonacci retracement, or you can just kind of find the valley of the mountains, and you can kind of see, well, this is a 50% support line. Apple made its earnings announcement and is bouncing to the upside. So as the price approaches major support level, becoming excessively cheap, buyers are most inclined to buy the asset. So let's look at CSX. It made earnings announcement last week. Your support line, if you connect the previous iteration that we had in the beginning of January when we had a sell-off, we made a year low, 33.5. And now after earnings announcement, we're bouncing to the upside. So now the support line is at $33.50. So if the market sells off in the next few days because of the volatility, then this line might get violated again, but short-term, this is kind of a short-term support for CSX, is that $33.50. So that's what we mean by support line. We look at the previous iterations, and that's kind of a draw support line. And I don't know, I'm not sure if, I think one of the presenters is actually have the speakers unmuted, so maybe you guys can mute your speakers so there's no echo in the background. That would be great. Great. All right. So this is an example of price support. And price support can actually be in different forms. That's why I said it takes years of experience to look at the charts and in your head draw these lines to find the support and resistance. But if you look at SPX chart, daily charts, then you can see a trend that's similar to this, where if you connect your picks, here the iteration of the pick, and you have another pick iteration here, that this is kind of your resistance, and you also have a support here on the bottom. So if I connect the values of the iteration, that's kind of your support, and you have a resistance if you connect the picks of each of the iteration, and this could be a daily chart, this can be your hourly chart, but in both cases the trends hold. If it's a longer term iframe, that the trend is more prevalent, and you can see how, if you look at the SPX chart, support and resistance lines get violated very rarely. You know, in October we had a sell-off, there was a geopolitical events. You know, every time there is a geopolitical buying events, then your support and resistance might get violated several times, like you see here. But most of the time, if the long-term thesis supporting, let's say, U.S. market is going to continue in an uptrend, you might get a couple of time violations of the support, but then the trend continues to the upside. Sorry about that. Okay, so again, you can look at the different advanced chart patterns. Here you can see multiple lines. You see multiple support lines, multiple resistance lines. So again, it's very important visually to connect these values of each of the leg of the stock or index movement and connect the resistance. And the important part here that all support turns into new resistance. So you see on this iteration, you see a support and resistance line, but then once the support line is broken due to earnings or binary event, the previous support line becomes your resistance. I'll try to close this. So the previous support line becomes your next resistance. So that's kind of important to spot, especially when you just start doing this technical analysis. You got to look at the chart, you got to look at the longer time horizon than how long you keep the trade on, and then you look at if this support line gets violated, like you see here, where the stock price broke the support level, that will be your next resistance level. So based on that information, you can kind of decide whether you want to short the stock or index here when it reaches the resistance, or go along the stock when it reaches that support level. And again, when we do our modeling, we take this price actions into consideration, and that's what identifies gets factored into probabilities, and we automatically find these trends and support and resistance for you, which is kind of a nice part, because you might spend hours, it might take you years to learn, identify support and resistance line, but then it takes you hours or days to actually sit and wait for the perfect entry into the stock, because Alcoa, if you can see it here, the stock might take you days to reach the support level. And so you have to be very patient. It's a very time-consuming process. You want to find software, you want to find a system that finds these support and resistance lines automatically, kind of alerts you when they happen. So what is the price resistance? Resistance is a price level at which supply is likely to be strong enough to prevent the price from seeing further rallies. As the price approaches major resistance levels, becomes excessively expensive, buyers are less inclined to buy the assets. So here's an example of Las Vegas Sands. We see as the stock made the earnings announcement and reached the overhead resistance, you saw that the price violated the 50% retracement of Fibonacci retracement, and then the 32% retracement, and continues the sell-off. So 50% retracement here at $59.50. This is a kind of a, on a 60-day chart, this is a long-term resistance, and you can see when the price is violated, the stock moves to the downside. You can also use 10 days and 30 days moving averages, the way we do a trade spoon. Once the price moves below the 10 and 30 days moving, and you see this kind of a crossover between the fast-moving average versus slow-moving average. When you see that crossover, that the fast-moving averages is below the longer-term moving averages, that could be a sell signal because the stock violated the resistance level, moved off of resistance level, violated support level, and moved to the downside. So here's example. Both example is highly subjective. It's a difference from trader to trader. Looking at the trends, as you see. From time to time, especially if you have a lot of volatility like we have in the market, the prices can go up, the prices can go down in a very short period of time. That's kind of we've seen the VIX move from 17 to 24 in the past 2 weeks in the beginning of this year. We think that this year is going to be very volatile. So it's very subjective process. Where do you connect the peaks? Where do you connect the values? Which peaks do you take to make that determination? So it takes time, and you want to try to avoid the subjectivity by using some kind of a automation process or a setup process that always works. And you can actually backtest it and see how many times it works and how many times it doesn't work. So range breakouts. When the price breaks out of the trading range above or below, traders have been given a signal. A winner has emerged. A break above is a victory for the bulls. And there's a lot of breakout traders. They look at the breakout after the binary event, after their earnings, when they see stock has been a trade in the range, and then it broke out from that range. Then there is a high probability the stock is going to continue moving to the upside based on this picture. So trends. Trends give traders an idea of general direction of an asset value. Trends exist as either uptrend, downtrends, or sideways. Trends can vary in length, short-term or intermediate or long-term. And identifying trends can be highly profitable because you will be able to trade with majority of the market and capitalize on previously established momentum. So this is an example of uptrend when we have higher highs and we're making higher lows. So 0.4 is higher than 0.2, 0.6 is higher than 0.4, 0.5 is higher than 0.3. So this is your uptrend example. Here's an example of a downtrend. If you're making lower lows, if 0.3 is below the low and 0.4 is below the 2, then it can be a continuation of the downtrend. That's why a lot of statisticians and technical traders look now at SPY or SPX index, and they're seeing that we're making lower highs in a shorter period of time in the past months. So if SPX drops below 1972, a lot of people say that we might have a reversal in the trend. So it's very important to see if this is a short-term correction in the market, and we have 5 to 10% correction in the market, or we actually reversing the trend. And if the trend is reversed, you kind of don't want to trade against the trend. That's the most important feature. And sideways trends are generally characterized as showing steady highs and steady lows in an asset value over specific time. So here's an example of the sideways trend. And again, as the importance of the trend, you do not want to trade against the trend. So if you believe that SPX, if the U.S. market is healthy and the earnings seasons would beat or meet analyst expectation, and as we go on into the earnings season, we will continue our momentum to the upside, then you do not want to take your short position. You kind of want to you want to take these sell-offs as an opportunity to go along the market, whether you trade in index or currencies or you trade in market or stocks. If you think that ECB will not continue with the asset repurchasing program, that GDP is going to go down for the world economy and also for US, and we will have a reversal of the trend, then you want to kind of take the opposite position and go short on your positions. But you want to kind of have a confirmation for the short-term trend by looking at the sell-offs and seeing if those sell-offs are sustained, especially in a high volatility environment. Because usually the short-term correction that are temporary in nature, they are done on low volatility like we had last year. But this year, all the short-term corrections are on high volatility, and that usually can indicate the reversal of the trend. And Fibonacci retracement, if you've seen some of the examples that we have, that basically taking the low point of the time frame and the high point of the time frame. Here on this chart, we're looking at the Fibonacci retracement. We're looking at the 60-day chart, but you can do also the same thing on 15-day chart. You know, you can look at a daily chart, but you take the low point, you take the high point, and whatever the technical software package you use, you can draw the Fibonacci retracement. And whether you use the 62% retracement or 68% retracement, these lines basically identify your major support and resistance level. So if you look at this picture right now, you can see that this 57.5 price is the long-term overhead resistance, and unless Las Vegas Sands beat their earnings estimates, most likely they're not going to trade above that level. So I'm going to use the rest of the presentation to kind of go over the trading plan. I think it's very important to have a trading plan, a trade spoon. Not only we tell you specific stock option spread recommendation, we also show you our detailed performance. And there's two reasons for that. One is we're showing what is the performance you can expect if you're doing stock trade, or option spread trade, what is the return per trade. We also show you if we do a back test since the inception, what results you can expect. But it also shows you what are every trade that we do, we show you why we enter into this trade, why we exit into this trade. And you can go back, let's say Juniper, you can go back to this trade. You can see on what day we made the recommendation, when did we exit this recommendation, and why was it a loser or a winner. You can see return on capital, you can see our volatility rank, you can see probability of success and estimated mood, and what was our price predictions for the stock. So when you can always analyze the stocks. You can always, that's the importance of the trading plan. You can go back in the past and you can see why you made the trade, and you can adjust your trading plan. Maybe you don't want to trade stocks that have high volatility change, or you want to trade lower beta stock because you're not comfortable with these high swings up or down. Or maybe the reverse. Maybe you want to trade high beta stocks like Amazon, trading Tesla, and Facebook because they move much faster and you're a day trader. But whatever the volatility you're comfortable with, whatever the return on capital you're looking for, you want to make sure it's recorded, and you can always go back and adjust your trading plan to make sure you avoid the emotions out of the trading and you follow those and you follow your system. So we show you detailed performance that you can look at the TradeSpoon site. You can also look at our backtest results. Since the inception, we record every single trade. You can see if you do you can compare if you're an option trader, what would be your good return for every month, and if you do option spread trader, what would be your return, or if you just trade stocks. So this is information based on the backtest and what would have happened if you allocate, if you start your portfolio with $10,000 and if you allocate only $500 per trade, 5%. You don't want to spend more than 5% of your portfolio into any given trade, because if the trade goes against you for whatever reason, due to these binary events that you cannot predict, doesn't matter what model you use, what technical analysis you use. Sometimes trades will go against you because of the binary events. You do not want to lose more than 5% of your portfolio, because it's very hard to get back, to recoup from your losses. So trading plan is extremely important. Here's an assumption: if you start with $10,000 portfolio and you allocate 5% per trade, $500. For our system, the trade on average holds, as I said, between 5 to 30 days. We are averaging 20% return per trade, so if you allocate $100 per trade, I took 5% of 10,000, which is $500, 20% return per trade, that's $100. If you do one trade a week, after 50 trades a year, you can make $5,000 on a $10,000 portfolio. Again, this is assuming no commission, so we're not taking into consideration commission that you're paying. We're not taking into consideration the slippage in terms of the prices we recommend and what price you can get in. But it is a starting point. It's a trading plan, and you can take this trading plan, adjust it based on what kind of trader you are, or modify this trading plan. And maybe you don't want to take 20% per trade because that's just too risky and it requires you to be comfortable with high volatility. Maybe you want to trade low beta stocks, but it's a trading plan, and by having this trading plan and looking for accumulation of your wealth from day to day, from month to month, you can see how much risk tolerance you have and how much profit you want to make on any given trade. So I'm going to type in, if you do want to have access to our analytics, to our price predictions, we do a stock and option spread recommendation that happens every day. We've come up with one new recommendation every single day. You can see them here. Or if you want to look at our, the best stocks that we have by scanning the results of our model and seeing, show me the best stocks that you think will outperform the market in the next 50 days or 20 days or 10 days. And we only want to see all the models that you have. So we're running 3 models right now independently. One is this longer term model, one is the shorter term model. If all the models show the buy signal or sell signal, we basically give you, here's the 7 names that you can trade, and you can use these names either for your day trading or for your longer-term swing trading, and you can see what our price prediction is for 20, 30, and 40 days. If you want to have access to this, we do have a special deal that you can see here, tradespoon.com deal, and I'm going to type that in the chat box. Their audience. So www.tradespoon.com/deal. So this, everybody's looking for trade ideas. Everybody wants to know what the entry and exit price to be. We do this research for you, and we trade these ideas ourselves. We're managing our own portfolio using these trade recommendation. So it's a perfect opportunity to find on every day 1 or 2 ideas, the specific entry and exit prices, and we also show you what are the trends going into the future and what are the prices that you can anticipate going into the future, by looking at our seasonal charts and by also looking at our weekly ranking of bullish and bearish stocks. So we have 5 minutes remaining, as Reed pointed out. I want to thank everybody for participating in the conference. If you have any questions, you can send them to vlad@tradespoon.com. If you have any questions on Tradespoon technology, we can go over them now. Let me see, I'm not sure if I can see the questions. Gene, solid webinar. I'm a beginner and this is my speed. Thank you. Thank you, Gene, for that kind words. I came late. Will there be a recording? Yes, Zaire, there will be a recording for this webinar. And I just posted the special to everybody, so you can look, if you want to take advantage of our technology and some of these specific trade recommendation, you can go to tradespoon.com/deal. Thank you, Vlad, Fabian. Thank you, Gene. How can you tell the bids versus sellers? I'm not sure what you mean, bids versus sellers, but if you want to, look at the, buyers versus sellers. If you want to, let's say you think that the market will underperform, and as we getting deeper into the earnings season and with all the geopolitical risk in Greece and ECB interest rate decision, let's say you think that the market is actually going to sell off, then you can say, what are all the stocks between 0 and 2 in our profit, and you can see here's 4 results. We're looking at the gas, we're looking at AMD, we're looking at C, and we're looking at the steel companies. So we have apparel, electronic, and steel. You can look at what our prediction. For ATI, we think that the next 20 days there's a 100% probability that the stock is going to be lower for ATI. Same goes for gas. We see probability of 20, 30, 40, and 50 days. So this is a perfect opportunity where you might want to short gas. We can also look at our probability calculator to find out what is the probability of gas being, if you want to short, above $23. Well, there's only 13% chance that the gas in the next 50 days will be higher than $23. If that's the case, you might sell 23 call or call spread, or you might, because right now we are in the time of heightened volatility, this is a time where you want to sell premium. So you can sell 22, 23 call, and there is only 1 out of 10 chance that you will be wrong and lose money. And obviously the closer you come to the current price of gas, the higher the chance is going to be that it's going to be higher and trade goes against you. But by looking at these predictions that the stock is going to be lower in the next 20 to 30 days, you might want to consider selling either February or March call spread and select the premium. Because at the end of the day, you do want to look at probabilities. Just like when you roll in, two dices, there is a higher chance that 7 will come out than 6 or 8, and it's a well-established probabilities based on the statistics. Stock market is the same way. There is a very well-defined probabilities of stock being at a certain price level by certain time frame, looking at quant models or looking at the options data. Options data, when market maker price your options, they already price in what is the probability of the stock being at a certain price by this Friday, by next Friday, by 1 month ago. So by looking at these probabilities, you do not want to trade against the odds, because you do not want to buy a 13 call when A, we think that all the models point to the downside, B, there's only 13% chance based on implied volatility that gas will be above $23. If you are going long on gas, especially if you buy on 23 or 22nd call, if you're using calls, or even if you're buying stocks, you kind of basically trading against the trend. And you probably don't want to do that because your odds are against you. It doesn't matter what technical system you're using.
Hey Vlad, don't mean to interrupt,
Yes.
but we are out of time, so we have like a little bit less than a minute left.
Perfect. I know you guys, some of you have more questions. I do only have a couple minutes left. I appreciate your feedback. If you have any questions, send me at vlad@tradespoon.com. I do encourage you to take us on that offer. There is no long-term. If you go to tradespoon.com, I didn't go there. But if you are going to this deal, usually our price is $97, but we're discounting for everybody who's on this webinar because we took an hour out of your time, 45 minutes out of your time. We want to build a long-term relationship. You now kind of have a understanding of what we're offering. So there's no long-term commitment. You pay basically as you go. You pay for 1 month. If it doesn't fit your trading style, then the most you can lose is $67. But if it is fit your trading style, I think for $67 you will greatly improve the probabilities of you being a more successful trader. And 1 or 2 trades can, recoup the monthly cost of that membership, and it's 30% discount. Our usual price is $97. You get 30% discount if you click on Enroll Now. If you click on Enroll Now, you get access to all of our tools and 30% discount, and for $67 you can get access to our tools. So Reed, I know my time is up. Thank you for having me. This is a great opportunity to be part of your audience, and I hope to see you guys soon.